It's interesting. We were talking about how the U.S. Trump administration, Diana, has really developed a sort of a pattern of a good cop and bad cop right now. And it's worked before in countries like Europe as well as Mexico to a certain extent. But do you think that China could actually yield to that sort of pressure?
Look, it's in China's interest to provide the U.S. and Trump ahead of midterm elections with some sort of a win. China's economy, in terms of its economic transformation and its desire to become self-sustaining in the future, is not there yet. China is not strong enough to have a full-on trade and geopolitical confrontation with the U.S. right now.
Where do you think the burden is going to fall the most then if we do see these tariffs on $200 billion of goods? Do I focus on supply chains more, or is this more going to be towards the U.S. consumer?
Look, this is actually geopolitical shifts in the global order. And even if China were to provide some sort of trade win for Trump to claim he got a win, this is not going away. This geopolitical confrontation will be the shaping force of how financial markets will develop in the next 2 to 3 years. And it carries with it very clear investor implications. Equity risk premiums are likely to go up to the levels they were during the Cold War. This is a new digital Cold War. Supply chains are likely to break up, so that has very clear sectoral implications, as well as actually for bond investors. It means that over the next few years, we are actually likely to see the return of inflation, cost push inflation.